Stocks and the stock market for beginners. In this course, I'm going to take you from the very basics of what is a stock, what are dividends, and why companies have stock in the first place. And then by the end of this presentation, we're going to cover how to find good investments yourself, how to read financial statements yourself. It's really not that complicated if we start with the basics. You can do it. And how to pay as few taxes as possible legally on our stock market gains. So this course is perfect for anyone with beginner or intermediate knowledge of investing. Basically, if you're not an investment banker at Goldman Sachs yourself, I guarantee you will learn something new. And hey, if you don't learn something new, I will introduce you to my 100% money back guarantee. But good luck with that, because this entire course is 100% free. This whole project is actually a bit of an experiment, and you are my test subject. So YouTubers are generally opposed to creating very in-depth, nitty-gritty content for free for two major reasons. First, they make more money selling it. I estimate I'm giving up about $90,000 by posting this for free. But most importantly, number two, people don't care. Most popular creators on YouTube feel people simply don't care about information unless they're paying for it. That's how you actually get someone's attention. So I'm going to pay really close attention to what the average watch time is on this course to test and see if YouTubers' assumptions are right. Do people care? So if you watch this for only a minute or two and then turn it off, I'll know that people indeed don't care unless they pay for content, and I'll have the answer to this grand experiment of mine. Now onto the course. This course has more than 50 sections to it. And I feel all the sections are important, but I've time-stamped all the major sections. So if you need to come back, or if you need to find a particular section, or if there's one area you're very curious about, you can do so quickly. Second, to help solidify the content, I have built a quiz that accompanies this entire presentation to test how much you've actually retained from it. Because what's important is how much you actually retain and you can take with you to the real world. So this quiz is built to be taken at the end, but you can do so alongside the presentation if you like an open book test. Whatever you want to do, whatever's the easiest way for you to learn, I'm totally open to it. And then third, I am really excited for you. I'm excited for you to watch this presentation and hear the feedback, because I spent around 50 dedicated hours putting this together in the most simple, coherent way possible. I don't think that there's anything else like this. And I even went so far as building all the charts and drawing all of the illustrations in this entire presentation myself. So I'm pretty excited about this. So grab some free stocks. Also, before we get started, there are various offers linked down in the description for free stocks with Webull, Robinhood, and M1 Finance. Feel free to utilize those if you like. And if you do so, those companies will send me a free stock too, as a thank you for sending you their way. Without further ado, let's get into it. And here we are, Stock Markets for Beginners, a free course for Neandernuts. If you aren't sure of who Neandernuts are, who is the Neandernut? That's you. You are the Neandernut, by yours truly, Max Maher. All right, I'm going to start off with some intros here and some definitions to cover our bases before we get in real deep. We want to make sure you understand everything before we get in deep. And we're going to start off real simply here. What is a stock? A stock, also known as a share, those words can be exchanged for one another, stock and share, represents a small piece of ownership in a corporation. Your total ownership is also referred to as your equity in a company, your equity share, your equity stake in a company. So here on the left, I have a diagram of a pie. We typically represent the shares of a company as a pie. In this case, there's only 4 shares. Each share is worth 25% of the company. And then on the right here, we have a pie with a few more slices. I believe there's 14 slices there. And each of those 14 shares are worth 7.14% of that company. Now, most public companies have millions, if not billions of shares. So you don't own anywhere near 7% of a company by holding 1 share in normal circumstances. But you can see all that needs to happen is that pie needs to be split up into more and more fractions to create more shares of a stock. Moving on from here, you are an owner when you buy a share of a company, when you buy a stock of a company. So buying a share or stock in a company means you actually own that slice of the business, believe it or not. Buying 1 share of Coca-Cola, for example, means you are actually an owner of Coca-Cola. Doesn't mean you can go in there and start bossing people around, but you actually own a small little slice of Coca-Cola. And this is actually the right fraction. If you own one share, you own I think it's 0.232% of Coca-Cola if you buy one share. Now, what it means to own a share of a company. Owning a share or the stock of a company entitles you to a portion of that company's assets and profits, and also voting rights depending on the kind of share that you bought. But we're going to talk about that in a couple minutes here, the different kinds of stock that you can buy. But doing some definitions, assets are a resource with economic value, which basically means it's worth money. An asset is a resource worth money that the company owns either because it's valuable in and of itself, something like cash, and or helps produce value like a piece of equipment. A tractor or a conveyor belt is worth money, and it also helps produce money. Those are both considered assets of the company. And you also are entitled to profits when you own a share of a company. And profits are the financial benefit that a company gets to keep after deducting expenses from revenue. So total sales minus total expenses equals your profit, equals the company's profit. Now, that doesn't exactly mean that is all going to be paid out to shareholders, because some of the profits get reinvested back into the business. Only a small portion, in only some cases, gets paid out as a dividend, which we'll explain all of that a little bit later. Not all shares are created equal, though. Share price means nothing without additional context to that share price. So repeat after me, share price means nothing without additional context, but that doesn't quite flow as well. So if company A's shares cost $10 and company B's shares cost $100, that does not necessarily mean that company A is cheaper than company B. This is a very common misconception, and you do not want to think that way. And that is because of market cap. Market cap is the total value of a company. In order to calculate market cap, you take the total number of shares, the total number of slices in that pie, and you multiply that by the share price, and you get the total market value of that company. So here's some examples, and this will highlight the share price discrepancy that I was talking about a second ago. So Coca-Cola, they have 4.3 billion shares. The current price is about $54 a share, which means their market cap is $232 billion. 4.3 billion times $54, $232 billion. Then we have GameStop, whose share price is actually higher than Coca-Cola by more than 4x. It's $217 per share, but the total market cap is $15.3 billion, far lower market cap, but that's because they have far fewer shares. So market cap is really what you want to look at when determining how expensive a company is, not share price. You need to know share price and total shares to understand how expensive a company is. And also, here's a note down here. A stock split increases the number of shares. So sometimes you'll hear about, like, Apple did a 4-to-1 stock split. It means that each share of that company is now split into 4 shares, and the value is also divided by 4. So if the share was $100 and there was a 4-to-1 stock split, that means you now own 4 shares worth $25 each. A reverse stock split is the opposite of that. So 4 shares to 1 share, for example. This does not change the value of the company. This does not mean the company is now cheaper, but companies do this because people tend to think that the company is now more affordable because the share price is lower. This is not the case. Do not fall into that trap. Moving on from here. Oh, it's all about the shares times the price, baby. I forgot that I wrote that there. Anyways, why do companies have stocks? Why do they have them? They have them to finance growth and the expansion of their company by giving up some of their ownership and some of their profits. So they sell off some of their ownership and some of the rights to their profits in order to expand the company, if there are profits. A lot of times there aren't profits quite yet when a company IPOs. It all depends on the individual situation. We'll define IPO in a minute here. So here's an example. And yes, I drew all of this. I did all the illustrations myself here. So Nice Buns and Company. Let's say you own 100% of this bakery, but you want to expand. You don't want to necessarily take out a loan. You want to sell a portion of your business in order to expand. This is what you can do. You decide you want to sell 25% of your company to finance that second location. So in order to do that, you sell 10 shares of your company to 10 investors for $20,000 each share. And this is the result of what happens after doing that sale. Each investor now owns 2.5% of your bakery. And by owning 2.5%, they are now entitled to 2.5% of the profits paid out to owners, and they own 2.5% of the assets. That doesn't mean that they can just go and sell 2.5% of the assets. They can sell their shares to someone else, but they own 2.5%. And the sale also means that you raise $200,000 to finance the second location of your bakery, Nice Buns & Co. And that means that you now own 75% of the company instead of the 100% because you sold 25% of your company. And this actually means that your bakery now has a market cap of $800,000. And remember, we get this by taking the total shares, which is 40 in this case. You sold 10 of the shares, but there are 40 total in the company, times the value of each share, which is $20,000. And that's how we get a total market cap of $800,000 for Nice Buns and Company. Moving on from here, what if you wanted to sell shares in the open market? What if you wanted to take Nice Buns and Company public? This is when a company IPOs, which is called the initial public offering. This is where a private company goes through all the regulatory and the underwriting process that allows them to then sell the shares of their company, if you wanted to sell that 25%, on the open market to the general public, to anyone. You and I could buy shares of Nice Buns & Co. So Nice Buns & Co. probably wouldn't be able to go public though, because they're simply not large enough, because this is very expensive to do, and there are pretty hefty requirements to do so on most exchanges. But that is what it means when a company IPOs and anyone is now able to buy a small portion of that firm. Now, moving on from here, the different types of stock. There are, believe it or not, different kinds of stock. Now, the most common one, you guessed it, is common stock. Basically, this is the one that most people are referencing if they say, I bought or sold a share of this company. It's typically common stock. Now, common stockholders get one vote per share of common stock that they hold, and they get their portion of assets, profits, and ownership in the company by holding their shares of common stock. And then we have preferred stock. Preferred stock still represents ownership in a company, but it has some pretty major differences. They usually don't have voting rights like the common stockholders do. They usually include a guaranteed fixed dividend. So a dividend is the amount that is paid out to stockholders. With common stock, that is not guaranteed. That is not guaranteed whatsoever. With a preferred stock, it's kind of like a coupon that is paid out on a regular basis based on a percentage of the total amount that you invested. Also, with a preferred stock, in the event of liquidation of the company, let's say it goes bankrupt and they just do an asset sale, they sell everything they have and try to convert that to cash and pay off debts, a preferred stockholder would be paid out first before a common stockholder. And also, the company has the option to purchase back preferred shares at any time. And usually if that happens, the preferred stockholders get paid more than what those shares are actually worth, generally for the inconvenience of having to sell it, maybe if they didn't want to. And finally, we have classes of stock. So companies can customize any of these criteria that we've talked about, from ownership, voting rights, dividend yield, you name it. They can tweak that and create different classes of stock. Now, not all companies even have different classes, but this is an option. A common example, or a more popular company that has classes of stock, is Berkshire Hathaway. They do this because their main BRKA has never done a stock split, and because the company has grown so much, the stock is hundreds of thousands of dollars per share. And they wanted to make this a little bit more accessible to the everyday stockholder. So they came out with a Class B stock that is 1/1500th the price of the Class A stock and has no voting rights. So that's one common example of a class of stock within a company. Moving on from here, what is the stock market? Getting back to the basics. So the stock market is a collection of markets and exchanges where you can buy, sell, or issue shares of a public company. So stock exchanges are the markets within the stock market. And these are the three major stock exchanges within the United States. We have the Chicago Board Options Exchange, the New York Stock Exchange, and the NASDAQ. So when you think of the stock market, you can kind of think it's like a market of markets. So let's say there was a grocery market, or you could say almost say the grocery industry is anywhere that you could buy food. And then a grocery chain would be like one of these stock exchanges within the grocery market. That's how you can think of the full stock market and the exchanges within that market. Moving on from here, what is a stock brokerage? A stock brokerage is the middleman that connects buyers and sellers of a stock. And here we can see I'm buying 1 share of Tesla from Meet Kevin. And I drew this earth. I drew that. If that's not worth a like on this video, I don't know what is. Now let's talk about the different kinds of stock brokerages. The first one is a full service brokerage. This is where a professional financial advisor manages all of your investment decisions, and they are there to answer any questions that you might have along the way. You pay a little bit more for this kind of service. Some examples here are Charles Schwab, Raymond James, and Fidelity all offer full service brokerage services. And then we have discount brokerages. This is the most popular version. If you're thinking of a stock brokerage, this is generally some kind of discount brokerage. So this is a platform that allows just your regular everyday investor who wants to manage their own money, they want to buy and sell shares on their own, it allows them to do so. It's an open marketplace, and typically they offer $0 trades. Some examples here, again, are Charles Schwab. They offer the full service or discount, whatever you want to do. Webull, which I have linked down below, you can grab some free stocks with Webull. Robinhood, also you can grab some free stocks down there. M1 Finance, more free stocks down there. You have tons of options when it comes to discount brokerages. Tons of places to go, but you might as well go with one that gives you some free money along the way. And then we have robo-advisors. This is kind of a newer type of brokerage. This is a platform that offers investment management services, but it's carried out by algorithms and AI, not an actual person who's looking at all the numbers and deciding where the money should go. So it's a lower cost version of full service. Some examples here that are pretty popular are SoFi. Vanguard has some options for robo-advisors, Betterment, and there are tons of other options with that as well if you're interested. Now let's talk stock market sectors, in which there are 11 of them. So let's talk about each individual sector just very briefly as to what it encompasses, and then give some company examples for each and every sector. The first one is industrials. This is businesses that generally use heavy equipment. We're talking railroads, airlines, and trucking and logistic companies. Some examples here are Southwest Airlines and Union Pacific. Next up, we have energy companies. This is oil and gas industries and businesses that provide equipment and services to oil and gas industry. Some examples here, ExxonMobil, Chevron, BP, you get the idea. Next up is materials. They provide goods for manufacturing and building. Some examples here are Nucor, which is a steel manufacturer, Cemex, which manufactures cement, and DuPont, which manufactures all sorts of stuff. Next up is utilities. You can guess what this one covers. Any basic utility, including electricity, natural gas, water, you name it. Some examples, Consolidated Edison, American Water Works, utilities. Next up is financials. These are the money handlers. This is banking, insurance, brokerages, anyone who is like a middleman facilitating the transaction of money. Some examples here are Wells Fargo, Aflac, Chase Bank, and Bank of America. Next up, we have consumer discretionary. Now, this one isn't quite as intuitive as the others, so this is defined as non-essential goods and services. Typically, consumer discretionary industries fluctuate with consumer income. The more income consumers have, the better this sector does. The less income, the worse the sector does. A good example here was COVID. Consumer discretionary was hit especially hard during the COVID pandemic. And these can be low-cost items that aren't technically necessary, or luxury items. Some examples here are McDonald's, Disney, and Ford. Next, we have consumer staples, kind of the opposite of consumer discretionary. This is essential goods and services. Demand does not typically fluctuate on this sector with income or the necessary state of the economy because it's things that people need to buy either way. We have here food, hygiene products, and household products that fit within this criteria. Some examples are Coca-Cola actually is part of this, even though you might think that's not a necessity. They're part of it. Walmart and Procter & Gamble. Now, with Walmart and Coca-Cola, you might be thinking like they could potentially fit within a different sector. And yes, there is some gray area here where you could shift a company from one sector to another. They're just not perfect. It's hard to fit every single company into only 11 different criteria. Next, we have information technology. This is companies involved in technical innovation. Some examples here are Apple Computer, Dell, Dropbox, tech companies. Next up is communication services. This is telecommunications like cell phone providers and media and entertainment providers. Some examples, AT&T, Verizon, Viacom, CBS, entertainment companies. Netflix would fit in that as well. Real estate, this is the next sector. REITs are included here, real estate investment trusts. We're going to go in a little bit more in depth on that later. And real estate development companies, some examples, Simon Property Group and Crown Castle. Then finally, we have healthcare. This is pharmaceuticals and biotech. Some examples are Pfizer and Teladoc. Now let's talk about the reason why you're here, how you actually make money with the stock market. How do you actually make money with stocks? We have dividends and we have appreciation of stocks. So first off, what is a dividend? A dividend is a portion of a company's profit paid out to shareholders, typically paid on a quarterly basis, so 4 times a year. Typical dividends are between about 1% and 7% of the stock price paid out annually. So a very simple example here. Let's say you bought a share of a company for $100. That company pays out a 5% dividend. That means $5 is paid out per share per year, which would come out to a $1.25 dividend paid out each quarter. Now, an important note, you don't have to sell a share to collect a dividend payment. It's passive income. It's really awesome to build up passive income, but it takes quite a bit of stocks in order to live off of dividends. Next, we have appreciation. Now, appreciation happens when the market value of the shares you purchased increase. So here's an example. You purchased 1 share of Nice Buns & Co., that bakery that we were talking about a couple minutes back. The ticker symbol is BUNZ, Buns. So you bought 1 share for $100. 3 months later, the market price of your 1 share is $130. Great job. Your 1 share of Buns has appreciated by 30%. That is appreciation. You increased your position by 30%. But it's important to note that you only get to keep the profits of that 30% appreciation after you sell. Until you sell, it is considered paper gains. Paper gains until you sell. It's locked in once you actually sell. And a note on top of the note, once you sell, there is a taxable event. So you don't actually get to keep the full 30% because you have to pay taxes on your gains, capital gains taxes, which we'll talk about later on in this video. Now let's talk about types of stocks as an investment. The first one is income stocks. This is the safest stock. I say safest because no stock is perfectly safe, but it's the safest type of stock due to low volatility and steady dividend payments. So volatility, let's just do some definitions here. Volatility is a stock's tendency to change in price rapidly and unpredictably. So a high volatility stock means it's less reliable. You can count less on that stock having a stable upwards trend. It may be all over the place if it's high volatility. If it's low volatility, then it could either be flat or a nice stable upwards trend. Now, a blue chip stock is the opposite of a high volatility stock. A blue chip stock is one that has a long reputation of positive profits and steady dividend payments. Moving on to the next type of stock, penny stocks. Penny stocks are typically shares of companies that trade for no more than $5. Now, typically when someone refers to a penny stock, they're referring to a stock that is less than $1, but technically it can be a penny stock up to $5 per share. These are typically small, high-risk companies. Next, we have speculative stocks. You might be pretty familiar with speculative stocks. Stocks of exploratory companies attempting to break into new technologies or new markets, or this could be stocks where investors are betting on a large turnaround in the stock's price or the financials of a company. Meme stocks fall under this category, so that's why I put our meme overlord Roaring Kitty down in the corner here.
Chupapi muñeño.
All right, next we have growth stocks. Growth stocks are stocks of companies who are trying to grow as quickly as possible. These companies don't typically pay out dividend payments because they are putting all of their earnings into growing the company and trying to capture as much market share and gain as much revenue as possible. They are reinvesting all their earnings back into growth. Then we have cyclical stocks. These are stocks that are dramatically impacted by the state of the economy. We have things like airlines, new vehicles, and luxury goods. This is consumer discretionary. Remember, if we go back to the sectors, this would fit in within consumer discretionary. Then we have defensive stocks, which again is the opposite of cyclical or discretionary. And this is stocks that typically remain unaffected during downturns. They are products or services that people need. Some examples would be food providers, healthcare, and utilities. These are the same as the sector consumer staples because demand does not typically go down, or it doesn't go down quite as much as income goes down or if the economy is being hit particularly hard. Then we have our last type of stocks on the continued page, and this is value stocks. These are stocks in which investors believe the market has undervalued. The price for the stock is lower than what investors believe it should be, and they think there's a buying opportunity here. So this is broken into two major styles. The first one is the Ben Graham style. So what Ben Graham would say is what I have written here: I'll buy anything as long as it's cheap. He would buy any company as long as the share price was cheap enough, even if it was a bad company. This is sometimes referred to as cigar butt investing. And then we have Warren Buffett style, who Benjamin Graham was his mentor. Warren Buffett took what he liked from the Benjamin Graham style and kind of turned it into his own. So his style is he wants great companies at a fair price. He would rather buy a great company for an okay share price than a bad company at a spanking deal, because he wants to buy a company and just simply hold it forever. That way he doesn't have to sell and he doesn't have to pay capital gains taxes on that sale. So the assumption with value stocks is the market is not always perfect, at least in the short run. It is not taking all the information in and giving a perfect price, at least in the short run. And because of this, Benjamin Graham, in his 1949 book, The Intelligent Investor, which is an amazing book, I'll have that linked down in the description. You should read it if you're interested in value investing. He describes how the market price for a stock is not always perfect in the short run, using this allegory of Mr. Market. So let me just explain this real quick. So imagine you are one of the two owners of a business, and your business partner is Mr. Market. Your partner every day, your business partner, either offers to buy your share of the business or to sell you their share of the business every single day. Your partner is either wildly optimistic about the company and its future prospects, or they are wildly pessimistic depending on the day, and it can flip 180 from day to day, or there could be a day where they're completely boring and like, whatever. So your partner is irrational, blows small events out of proportion, and is moody in the short run. And Benjamin Graham says this is the stock market. The stock market is essentially sending you a price quote every single day, and a lot of the daily price action is due to small events that don't typically matter quite as much in the long run. And here's an excellent quote by him and a great way to think about the stock market both in the short run and the long run. The quote is, in the short run, the stock market is a voting machine. In the long run, a weighing machine. So what does this mean? A weighing machine, a voting machine? In the short run, a stock price is swayed disproportionately by small things like news events, analyst projections, drama, rumor, hype, you name it, that affects the stock price dramatically. But in the long run, the stock market and the price of individual companies is determined much more by the value it creates. That's why I made this off-balance scale where it shows cash is more important in the long run than something like an Elon Musk tweet in the short run, which can sway markets for a day. But in the long run, it matters more. What is the actual value that's being produced with this company, with this asset in the stock market? Next up is an ETF. What is an ETF? An exchange traded fund. So an ETF is a tradable financial instrument that allows you to purchase a small portion of a diverse bundle of multiple securities. So ETFs can track a ton of different things, like an index, a sector, a commodity, or any other asset. We're going to dive into this so you can completely understand this. Just don't check out. Don't check out. You'll understand it in a minute here. So the most popular ETF is the SPDR S&P 500 ETF. SPY is the ticker symbol. Buying a share of SPY actually gives you a small little slice, a small little portion of the 500 largest companies in the United States. So we have a share. Remember, that's a small slice if you were to buy one share of any one of these 500 companies. One share of the SPY ETF gives you an even smaller slice of 500 companies, the 500 largest companies. So it gives you this nice diversification. So here is an example of a stock versus an ETF, not to be confused with livestock. These are supposed to be cows, but now that I look at it, it kind of looks like I drew a goat. But anyways, so buying an individual stock, it's kind of like buying one cow. So let's say you have $100. You want to get into the milk game. The milk game is hot. So you have $100. You could either buy one cow for $100, or you could put a $100 stake in for 10 cows. So what happens here, if you have one cow, it's more volatile. That cow could produce more milk one day, less milk the day after that. You don't know what's going to happen. It's less predictable. But if you have 10 cows, you know the average of those 10 cows could give you a more predictable return. That is kind of like buying into an ETF. You get a little bit more diversification, you get a little bit more of a consistent return. There's going to be fewer low lows and fewer high highs as far as what your return is in that investment. And then we have an index fund. An index fund is a type of ETF that is built to match or track a financial market index. So a market index is a bundle of securities that represent a category in the financial market. So some examples of this could be a large cap stock, so stocks with a huge market cap, or small cap stocks, stocks with a small market cap, or growth stocks, value stocks, consumer defensive stocks, tech stocks, any number of categories that we already mentioned. This could be an index fund, and there generally is already an index fund on anything you could think of. There are so many index funds. So two popular index funds are the Dow Jones Industrial Average and the NASDAQ Composite Index. So when someone says, oh, the Dow is down 0.5%, they're talking about the Dow Jones Industrial Average Index Fund being down 0.5%. Same with the NASDAQ Composite Index. So now when someone says, oh, the NASDAQ is up 1%, you know exactly what they're talking about, and you can come back and say, thanks, I sounded smart by the water cooler today at work. And then next we have mutual funds. Mutual funds are similar to an ETF, but it's a professionally managed financial instrument that pools money from investors, similar to an index fund or an ETF, but it aims to beat market returns, not match market returns, by purchasing a variety of different investments like stocks, bonds, or other assets. So mutual funds, like I said, are similar, but their performance is based much more on the fund and the fund manager's success than specific assets or a specific index performing well. And typically mutual funds, even though there's someone there trying to make the best return possible, typically they return a worse return than an ETF or an index fund unmanaged in the long run. It's nearly impossible to beat the market in the long run. Now, I know it's confusing with the differences between mutual funds, index funds, and ETFs, so I made this handy Venn diagram. Is it a Venn diagram if there's three? So I made this so we can tell all the similarities and the differences between an ETF, index fund, and mutual fund. So let's go over this. We're going to start in the middle with the similarities between all three. So first, investors are pooling money. So with all three of these, many investors from all over the world are pooling their money to give some more buying power in these individual funds. They also all are a way to hold many different securities. Remember, it's the difference between buying that one cow or buying the stake in 10 cows, and they all help you diversify by being able to be in all these different securities or asset classes or whatever the ETF, index fund, or mutual fund is that you're buying into, whatever the focus is. Now, if we go to the top left to what is unique about ETFs, we can see ETFs can be purchased anytime during trading hours. So that's different than index funds and mutual funds. With index funds and mutual funds, they can only be bought or sold once per day. At one time per day, those trades are executed. With ETFs, also there is a very low investment amount. Typically, there is no minimum amount. You can invest $1 if you want to. And the average fees with an ETF are 0.44%. Now, if we go to the top right to the unique criteria of index funds, we can see the minimum investment amount varies. It can be zero in some cases, but it also can be as high as $3,000. So you may have to, depending on the index fund, buy a minimum of up to $3,000 in order to buy a chunk of that index fund. The average expense fee for index funds is the lowest of all three, with 0.09%, because they're largely unmanaged. They're a low fee way to diversify your money. And index funds really are the best place for most people to plunk down their money if you don't want to spend hour after hour tracking individual stocks and investments and trying to beat the market, which nearly no one can do. Index funds are a great option for nearly everyone, and most people should have a base of their portfolio, at least in index funds, and then potentially have some individual picks on the side. Now, if we go to the bottom to the unique criteria of mutual funds, we can see mutual funds are actively managed. So there's a fund manager making buy and sell decisions within a mutual fund. The goal of a mutual fund is to beat market returns, not just match market returns like an index fund would or an ETF would, depending on the ETF. They have high average fees. They have the highest fees of the three here, with average fees of 0.82%. Now, you can find fees lower than this and higher than this, and they have the highest minimum investment amount, typically between $500 and $3,000. Now, if we look at the similarities between mutual funds and index funds down in the bottom right corner here, we can see that buy and sell orders are only executed once per day. So if you make a buy order for a mutual fund or index fund today, it'll be executed tomorrow at market open in most cases, where with ETFs, it's more similar to just buying an individual stock. You place that buy order and it just goes through right then and there. So I hope that this Venn diagram helps clear the air as to the differences between ETF, index funds, and mutual funds. What are REITs? Real estate investment trusts. REITs are a company that owns, finances, and operates income-producing real estate. So we can think of it as a combination of a dividend stock, because nearly all REITs pay out a dividend, a mutual fund because of the diversification factor and the pooling of investors' money, and a real estate investment at the same time, because REITs are actually buying physical real estate and then taking profits from it and paying it out to shareholders. So REITs allow investors to earn income off of real estate without actually having to buy or manage the real estate yourself. And you get a nice little piece of diversification along with it. Now I made this diagram just to highlight the key features of REITs. So we can see we made a little pie here with a bunch of houses in it. With a REIT, you're essentially buying a slice of a real estate portfolio. Now some REITs are targeted in that they may focus solely on single family homes or commercial properties, and some other REITs are fairly diversified in different types of real estate within the real estate asset class. So you'll want to take a look at the particular REIT that you may be interested in to see what types of real estate they are investing in. So some key features here is it gives you exposure to a different type of asset class that you might not have exposure to, which is a good thing when you're trying to have a balanced portfolio. Typically with stocks, we have a lot of exposure to the stock market and to consumer companies. This allows us a little bit more of diversification and diversification within diversification, because if you, for instance, buy a single family home as an investment property, if for whatever reason that doesn't produce income for the year because there's some issue at that property, you just don't make any income. However, if you buy a REIT, you're getting that small slice of many different properties, so you're more diversified. What this does is reduce the lower lows in terms of your investment and reduce the higher highs. You get a more stable return with a larger portfolio that is diversified. Also, this can be any kind of income producing asset, including homes, apartments, commercial real estate, hotels, hospitals, cell towers. As long as it's any income producing physical asset, there can be a REIT based around that thing. And shares of REITs can be bought at any brokerage. Whatever brokerage you want to use, you can buy shares of any particular REIT. And 90% of the taxable income must be paid out to shareholders. So it's kind of unique in that nearly all of them, as long as there is income, pay a dividend and have to pay a sizable chunk of all their income out as dividends. So it's a bit of passive income as well. What is risk in the stock market? Because unfortunately, contrary to popular opinion, stocks don't always just go up. So we need to talk about the risk, because all investments come with some form of risk. In stocks, it largely comes down to three different types of risk. The first one is market risk. This is also sometimes referred to as systematic risk. This is the risk that entire markets can drop due to unforeseen events. COVID. And this can't typically be diversified away within a single asset class. So if you were to buy into stocks, you still have the market risk that the stock market as a whole could go down. Now you could diversify into completely other asset classes that tend to perform better in certain scenarios, but within a market, there is market risk. Next, we have specific risk. This is the risk associated with an individual company, an individual stock. Now this could be anything about the company. It could be its level of profitability or lack thereof. If sales are down, if the management is having issues, or there's drama, or there's some scandal with management, or there's bad press, or there's fraud within the company, this could be anything having to do with the risk of an individual stock or investment. And then third is interest rate risk. And this is the fact that stocks tend to go up when interest rates decrease, and they tend to go down when interest rates increase. So there's risks with interest rates changing. Now we need to talk about risk tolerance and what is your risk tolerance, because it is different for everyone. So in order to help explain this, I want to pose some questions, and that way you can just take a minute, maybe pause the video and just think, what is my risk tolerance, and try to answer all these questions to get a better idea as to how you should potentially invest. So your risk tolerance, you can also think of this as how much are you willing to lose without losing your mind and panic selling in the event of a market correction or some temporary event that could lower market prices or stock prices. So a couple questions to ask yourself, and I really think you should answer these yourself. Number one, are you concerned about losing money? Are you investing some amount that you're concerned about losing? If you're like, no, it's no big deal, then you might have a higher risk tolerance. Number two, how much are you willing to lose? If you have $10,000 to invest, are you willing to potentially lose $2,000, especially in the short run, $3,000, $4,000? How much are you willing to lose in order to get a higher return? Because of course, higher risk, higher potential reward, potential. Number three, how worried do you think you'll be when the market declines? If you're an investor for long enough, you will experience market and individual stock declines that will hurt. It will hurt. How worried do you think you'll be? And then whatever your answer is to that, multiply it by 2, because you're probably going to be much more worried than you even think you are. And you want to make sure that you don't make any irrational decisions. Number 4, how old are you and how much time do you have? The younger you are, the more risk tolerance that you have, because you have more time to recoup your investments, because the biggest thing about making more money is having time. If you're older, you may want to be more conservative with your investments. Number 5, how much money do you have? If you have $100,000, then $10,000 isn't as big of a deal. If you only have $10,000 in your name, maybe you don't want to be quite as risky with that. Maybe you want to place it into safe bets and then build up that nest egg. Number 6, how diversified do you want your portfolio to be? Of course, the more diversified, the more safe it is, but the returns are unlikely to be as high in a diversified portfolio. Number 7, what returns are you looking for? We want to be realistic with this. An 8% compounded return is great over the long run. You can't have unrealistic expectations. You can't expect your money to double every year. If you are expecting your money to double every year, you will lose your money in the long term. It's possible to make bets that double or triple or quadruple, but in the long term, if you're constantly trying to make these bets, you will lose money. And then finally, do you need the money for something else? Let's say you have $20,000 that you can invest right now, but you're going to use it next year to place a down payment on a house. You probably don't want to put that into something risky, so you have that $20,000 to put down next year when you need it. Maybe you want to put it into something a little bit more conservative. And then to help explain risk level, I built this tower of returns. So it's high risk at the top, medium risk, and then low risk. Now, of course, within the medium risk, it varies quite a bit as to the actual individual risk. So for example, let's just start with the middle. We have ETFs, we have REITs, we have high income bonds, but we also have real estate and mutual funds and large and medium cap stocks. In reality, a large or medium cap stock is quite a bit more risky than something like an entire ETF, especially if it's like an S&P 500 ETF, but those are medium risk. In the high risk category, you're looking at options, crypto options, or speculative stocks, meme stocks, or futures or collectibles, things like stamp collections. Gold would even fit in within the high risk category here. And then the bottom, low risk, if you're young, chances are you don't really want to bother with the bottom, but of course none of this is investment advice, but these are by far the most safe ways to store your money. And it's really more a store because you're not going to get a huge return. We have government bonds, we have bank accounts, which return next to zero. Inflation protected securities for high inflation environments. Of course, the return on that is very low as well. Cash, which you actually lose money over time with inflation. Then you have CDs, notes, and bills. Now let's cover some portfolio examples. Now there is no perfect portfolio and opinions vary wildly with portfolios. Some people say you should put all your money into Bitcoin. Some people say that you should put all your money into ETFs. These are just some examples. This is not financial advice. It's just some ideas. So up in the top left here, we have Warren Buffett's portfolio. He does about 10% in short-term bonds and 90% in stocks. Now, many people think of him as a safe investor, but in the grand scheme of things, he actually has a little bit more on the risky side of portfolios, being so heavy in stocks, especially at his age, at more than 80 years old. Then we have another legendary investor in the bottom left, Larry Swedroe, with a slightly less risky portfolio. So he does 70% intermediate treasury bonds, 15% small cap value stocks, 7.5% developed market small cap value stocks, and 7.5% emerging markets value stocks. And in the top right here, we have a general overview of portfolios you may want to consider based on your age. A general rule of thumb is you may want to put 1% allocation of your portfolio into bonds for every year old you are. So they say over time you should invest less and less in stocks because bonds are generally safer. So if you're 30 years old, the general rule of thumb is to have 30% of your portfolio into bonds. Now I know many people don't like bonds, especially right now when bond rates are extremely low, but this I just want to cover general applications and general options here. So we can see a young investor, they're recommending 80-20 stocks to bonds. But then a late retirement investor, they're recommending a large portion in cash and a small portion in stocks and a larger portion in bonds. So of course, this really changes as you age. And again, there's no perfect portfolio. And then the bottom, I made this just average young investor. What if you're young, something you may be interested in doing as a potential option. This is a little bit on the more risky side, but it's not crazy risk. So with this, we have 40% large cap index fund, something like an S&P 500 or an S&P 500 growth or something like that. We have 10% crypto in meme stocks because I know every young investor is interested in these ultra high returns, the crypto, meme stocks, speculative stocks. So 10% allocation, I think that's fairly safe. On the safe end anyways, if you are young. 20% individual reliable stocks. So if you're someone who wants to try and do stock picks, you could do 20% and still have a relatively safe portfolio. And then 30% growth index funds. So growth companies. When you're young, you generally want to focus more on growth than on dividends because you want that to compound. You want your money to compound without having to pay taxes on that. In the long run, that will earn you significantly more money for retirement. Now you might be thinking, this is way too much to think about allocating portfolios. Like, I don't want to deal with any of this. You have other options. There are robo-advisors who can help you out here. There are actually ETFs that have set retirement dates. So let's say you think, okay, I want to retire in 2065. You can buy an ETF that automatically changes year over year, changing the allocation of your portfolio until your retirement age. So it would do something like be heavy on stocks right now, but then 40 years from now start to transition into safer securities. So there are options like that that are much more simple. And honestly, for most people, a simple option is best because unless you're willing to spend many hours researching and understanding your investments and keeping up with them, it's probably better to do something like an index fund or an ETF to be safe because rule number one, you do not want to lose money. Can you time the market? And the answer is not really, at least not consistently. It's possible to get it right sometimes, but it is impossible to knock it out of the park every single time when it comes to timing the market. Now, I guess, what does timing the market even mean? This means buying or selling stocks based on an expected price change. So you think the stock's going to go up, so you buy now. You think the stock's going to go down, so you sell now. And here's some examples of that. So, Apple's quarterly earnings are on Friday, and I know tons of people who bought the iPhone this year, so I'm going to buy now because I just know their earnings are going to be good. You know what? I think the market's going to crash, so I'm not going to buy any stocks for at least the next month or so. In theory, timing the market makes sense. It seems obvious, really. Buy now if you think the price is going to go up in the near future, sell now if you think it's going to go down. But it's much harder in practice, and no one can do it consistently. A perfect example of attempting to time the market is mutual fund managers. They have all the assets and the technology you could possibly ever want at their fingertips, and they still aren't able to even match market returns on average. So here's a stat from 2019. On average, mutual funds returned at 26.14%. In the same year, which that's a great return, but in the same year, the S&P 500 returned 31.49%. So even mutual funds with everything at their fingertips struggle to match the market, much less beat the market. Hence, timing is very, very hard to do. But this isn't to say that it's impossible. It's just, like I said, not possible consistently. Remember, markets can overreact. They can overreact to news events, drama, political events, you name it. And occasionally, you're able to buy low because you called it right, but it just does not work, unfortunately, 100% of the time. Sometimes there may be a dip and you'll buy the dip and that dip just keeps on dipping. And that's just how it goes occasionally. And that brings us to the next strategy, dollar cost averaging. What is that, you might ask? I got you covered. It's a strategy where an investor divides the total amount that they plan to invest into regular set purchases over time. Here's an example of that. So I have $20,000 saved up and I really want to start investing and start earning money off of my money. But I'm kind of worried about plopping that $20,000 down and then seeing a 5 or 10% correction just because I happen to buy at the wrong time. So instead of just buying $20,000 today, I'm going to instead buy $2,000 worth of an S&P 500 index fund for 10 weeks. Every single Friday, I'm just going to buy $2,000 worth. That way, it'll flatten out the volatility a little bit, give me a little bit less risk, and I'm not going to have any emotions into the decision of buying. how to analyze a stock. This is where things get very exciting, but also pretty complicated. So I want you to hang in here with me. You might have to watch this section a couple times. There's no shame in that. You might have to watch it at half speed. There's no shame in making sure you understand this, because this is a true case of knowledge is power. Because once you understand how to actually analyze a stock, this is when you turn into a real investor, especially if you're trying to do individual stock picks. You want to be able to tear a company apart and look at the inner workings and understand the financial health of a company. And that's what we're going to cover here, at least the basics as to how you get started with it. So we're going to first cover fundamental stock analysis, and this is going to be quite a large section. And then we'll cover technical analysis a little bit after that. So fundamental stock analysis. This is the process of understanding the past, the present, and the potential future prospects of a company by taking into account basically anything you could take into account. Their sales, their financials, their rate of growth, their profitability, their health, the industry health, where's the industry headed, the management team's competency, much, much more. Literally anything that could affect a company, you can factor into your calculations for a fundamental stock analysis. So in order to start this off, we need to start with the basics, the financial statements. There are three main financial statements: the income statement, the balance sheet, and the cash flow statement. And they all relate to each other, kind of communicate with each other. We're going to break down each one individually, and then we're going to talk about how they relate. And we're going to do it in as simple terms as possible. And I think you'll be able to follow this and then know much more about financials after this brief section. So first off, the income statement, also known as the profit and loss sheet or the P&L. This is the first place you'll typically look at when you're analyzing a company. This shows the overall performance for a company during a time period. Typically that time period is either quarterly or annually. Quarterly being, after the earnings call each quarter, you get a new P&L, you get a new set of financial statements, and then annually, those 4 quarterly statements are compiled to an annual report. This starts with sales revenue and then deducts the costs of goods sold, the cost of actually producing the good or service that you're selling. And this gives you gross profit. Gross profit is then decreased by operating expenses, and that gives you the net income. So I have made an example of a fictitious company. It's called Max's Meats. Go figure. It's called Max's Meats, and we've made a fictitious income statement, cash flow statement, and balance sheet. We're going to just start with the income statement right now. Break this down piece by piece. So Max's Meats had $100,000 in sales in its first year of business. The meat business is a good business to be in. Our cost of goods sold, $40,000, and that gives us a gross profit of $60,000. Our expenses, general administrative, this is things like the back office staff, any general expense could fit into here. We have $5,000. Research and development, we were trying to figure out how thin you can slice beef jerky, so we spent $1,000 on our research here in the beef jerky market. Sales and marketing, fairly low, $3,000, because Max's Meats, they just sell themselves. We really don't need much sales in marketing or advertising. So our total expenses here, $9,000. We deduct that $9,000 from our gross profit of $60,000 and gives us an EBITDA of $51,000. Now, EBITDA is earnings before interest, taxes, depreciation, and amortization. Some investors would rather use EBITDA instead of net income because it isn't subject to quite as many fluctuations, but we're not going to get into that on this video. And then our net income is $51,000. So now that we understand the income statement, we need to understand the statement of cash flows. The statement of cash flows takes in the net income and then adjusts that net income by factoring in non-cash expenses, because the net income only tells us so much. So the statement of cash flows displays the change in cash on a given period. Usually that period, again, is quarterly or annually. So the change in cash in that period, it displays the beginning balance of cash within that period and the ending balance of cash in that period. So let's look at our example here again for Max's Meats, our fictitious company, our statement of cash flows. So we have our net income of $51,000. We have a decrease of accounts receivable, or increase depending on the situation. So what is accounts receivable? Accounts receivable is money that we have yet to receive. So we sold some of our product, we sold some beef jerky or something like that, and our customer has yet to pay us. So there's a $2,500 deduction that we need to factor in because we have not received that cash yet. And then on the other flip of the coin, the other side of the coin here, we have accounts payable of $1,000. So this is the opposite. This is money that we have yet to pay pay in our expenses. So we have a supplier that we had a $1,000 charge. We have yet to pay them. So the cash hasn't actually come out of our accounts, and we need to factor that into our cash flow so we know where we're actually sitting at present day. And then we have net cash from investing. In this case, we're just going to leave that blank because we're going as simple as possible. Our net cash from financing, this would be if you bought an asset like a truck or some fancy beef jerky slicer and you got a loan on it, it would be factored in here. And then we have common stock. So in this example, the founder of this company, which I guess would be me, I'm Max of Max's Meats, added $10,000 to the business in common stock. So I added $10,000 to the business bank account, and that needs to be factored in to the total cash position. So we take that $10,000 and we add it to our cash up here of $49,500, and this gives us $59,500, which is the total cash coming into the company this year. Total cash coming in this year. And then we have the cash at the beginning of the period. This is zero because this is our first year of business. So if this was our second year of business and in the first year we had $50,000, there would be $50,000 here. And then cash at the end of the period is just again $59,500. If we had that last year $50,000, we'd be adding $50,000 plus $59,500 together, and that would be the cash at the end of the period. But again, this is the first year in business for Max's Meats. I don't know why I do this to myself. Next up, we have the balance sheet. The balance sheet is the last of the three, and then we're going to talk about how they commingle with one another. So the balance sheet displays a company's assets, liabilities, and shareholders' equity at a specific date. It's kind of like a snapshot, usually at the end of a quarter or the end of the year. It's like a snapshot net worth of the company on that specific date. So it begins with cash and cash equivalents, and then it shows changes in the accounts, and then it should end with a balanced account. That's why it's called a balance sheet, of the same amount that it starts with up on the top. And this shows the financial position of the company. Again, it's like a snapshot. Net worth snapshot. So if we look at Max's Meats balance sheet here, we can see the cash is $59,500. The accounts receivable money that we expect to come in is $2,500. So in this case, because we expect to be paid from our customer, we're going to add that to our net worth. Because the customer owes us a debt, we're adding that to our net worth. So our total net worth is $62,000 of this company. Our long-term assets and equipment, that is still blank because we're keeping this simple. Our liabilities, our only current liability is that $1,000 in accounts payable. So that's what we owe our supplier, $1,000. That needs to be deducted from our company's net worth. So our total liabilities, $1,000. And then our equity section. First off, we have common stock. So that $10,000 that I added to the company, that needs to be factored into the net worth because, of course, it's within the company's accounts. Retained earnings, this is the total of the company's profits and losses since the beginning of the company. In this case, it is $51,000. And that $51,000 plus $10,000 in common stock gives us $61,000, which is the total equity, the total net worth of the company after all conversions. Our total liabilities and equity combined is $62,000. And yep, that matches our $62,000 up top. So our accounts are balanced and we are good to go. So now we understand what each of these statements does individually. We need to zoom out a little bit and then talk about how they communicate with one another and relate to one another. So starting with the income statement, nothing has changed here. We have our revenues minus our expenses gives us our net income of $51,000. That $51,000 is taken from the income statement and put up on the statement of cash flows. Here, $51,000. So I've color coded this to the cells that should match, the numbers that should match within these three statements, so then it's a little bit easier to see how they communicate with one another. Now, there's nothing, again, changed in the statement of cash flows here. Our cash at the end of the period is $59,500. And then we take that $59,500, and that's what starts the balance sheet up here of $59,500. And then on the balance sheet, this is where we're really pulling numbers from the other statements. This is where we're going to see it kind of all come together and see how they communicate with each other. So we have the $59,500, accounts receivable, $2,500. So that is pulled from the statement of cash flows. And then we go down to our liabilities to accounts payable, $1,000. Again, that is pulled directly from our cash flows. So that should match. When you're looking at a company, that should match. The accounts receivable should match from the cash flows and the balance sheet. Common stock, again, we pulled that directly from the cash flows. It matches. And retained earnings, this $51,000 should be the same as the net income on the income statement. And then finally, at the end here, $62,000. This matches our $62,000 up above, and we are good to go. This is how they communicate. This is how they commingle with one another. Now, Again, like I mentioned before doing this section, you might have to watch this section more than once. That is totally fine. But you want to understand this section more than any other section. You want to understand this if you're trying to do individual stock picks, because it will help you so much in analyzing a company. Now, this is a brief overview of financial statements. If you want a more in-depth look, there's a book that I really recommend, and it's called A Step-by-Step Guide to Understanding and Creating Financial Reports. I will have that linked below, because that is really helpful if you want to go much more in depth, because we could have a 10-hour video just on financial statements. It can get so complex, especially when you're looking at huge public companies with far more accounts and far more expenses and turnover ratios and things like that. We're going to get a little bit more in depth, but I recommend that book if you want to get very in depth on this subject. Now that we have an understanding of financial statements, we need to talk about financial ratios. Financial ratios are an extremely useful tool when trying to analyze a stock, analyze a potential buy, because what this does, it allows you to compare a company to its competitors, compare a company to standard metrics of these ratios, and compare a company to industry averages. This helps you build a much better picture of the health and the value of a company. So we're going to cover a few popular ratios that are very useful to understand, and then we're going to show how you actually find the data to calculate those ratios within the financial statements that we just discussed. So, starting with the PDE ratio, the price to earnings ratio. This is the most popular financial ratio, and this tells us how much an investor needs to invest in a company in order to receive $1 in earnings. So if you have a PDE of 15, this means you need to spend $15 on stock in that company in order to earn $1 in earnings in 1 year with that company. If the PDE is 5, you only have to spend $5 in order to earn $1 in earnings. If the PDE is 100, if it's a high PDE, that means you have to spend $100 in order to earn $1 in earnings, and you get the picture. Some companies don't have a PDE, and this is because they are not profitable. So it's impossible to calculate because there's no earnings. A high PDE indicates that the market expects a company to grow in the future. So we see this with companies with a lot of hype around them, or brand new companies who are barely profitable but have high expectations. A low PDE indicates the market may be undervaluing the company, or there's some kind of news that has come out where investors feel it should be worth less compared to either its competitors or the average PDE. So how do we calculate PDE? It's literally the stock price divided by the earnings per share. So if we go over to the computer, we're on Market Watch here, we're just taking a look at Tyson Foods. We can see that the stock price is $72.76 per share. So we're going to take that, and then we're going to divide that by the earnings per share. In order to get that, we're going to go to the financial statement, and then to the income statement. We scroll down to EPS, that's earnings per share. Take a look, it's $5.79. So we take that stock price divided by $5.79, and that gets you the PDE. In this case, it's about 12.5. Typically, a PDE of under 15 is considered a value investment. Next up, we have the current ratio. You can think of this as a company's ability to pay short-term debt obligations. That's debt obligations that are due within 1 year. So how well do current assets satisfy the current debts of a company? And that's how you calculate it. Current assets divided by current liabilities. And the ratio for this can vary pretty wildly based on industry, because some industries are just naturally much more asset heavy and liability heavy than other industries. For instance, the airline industry tends to have a ton of liability. So judging an airline to another company in an industry that has low liabilities can make you think the airline may be worth less. So it's important to always compare both with general guidelines and industry guidelines and competitors to see where a company lands as far as these ratios. So a current ratio of less than 1 is generally bad. That means that the company has a lot of liabilities compared to its assets. Now let's show how you find these numbers within the financial statements here. So we need current assets. In order to get current assets, we go to the balance sheet. We remember what the balance sheet does. We scroll down a little bit here to total current assets. We see it's $7.6 billion. And then we need total current liabilities. So we're going to scroll down here and look for total current liabilities. and we got 4.23 billion assets divided by liabilities. One thing to look out for, make sure you're actually looking at current liabilities, not total liabilities. Those are completely different numbers. Total liabilities, you can see that's much higher in this case. Next up is the P to B, the price to book ratio. This tells us how a market values a company compared to the value of its assets on the balance sheet. So the market capitalization of the company compared to if there was an asset sale, how much those assets could actually sell for. In order to calculate the price to book, you take the stock price and you divide it by the book value per share. Now this one's a little bit harder to calculate than the last two that we described, but it's still not too bad. So book value per share has a calculation in itself. In order to calculate that, you need stockholders' equity minus preferred stock. Now many companies don't have preferred stock, so in a lot of cases it's just going to be stockholders' equity, and then you'll divide that by shares outstanding, the total number of shares in the company. And a price to book of under 1 is generally considered a bargain. So first off, we need to find stockholders' equity. So in order to do that, we're going to go to the financial statements, go to the balance sheet, and we're going to scroll down here towards the bottom, and we look for total shareholders' equity. It's $15.25 billion. And then we need to find the preferred stock, and we can see the preferred stock is right here. This company does not have any preferred stock, so we just use shareholders' equity, $15.25 billion. And then we need to divide that by the total shares outstanding. On the case of Market Watch, then you can just go to the company overview, and it'll tell you the total number of shares here, and that is 294.77 million outstanding shares. So it's just that equity divided by the total number of shares, and you got your ratio. Next up, we have the D to E ratio, or more commonly called the debt to equity ratio. This tells us the level at which a company is taking on debt relative to its net assets. So a high debt to equity ratio means the company is aggressively financing its growth with debt. It's taking on debt in order to grow as quickly as possible, which of course increases the risk in that investment. So the D to E is calculated by the total liabilities in the company divided by the total shareholders' equity. Maybe pause this and go on a financial statements and just see if you can find total liabilities in the balance sheet, and then come back to this video. Okay, you're back. Also, a D to E of around 1 is generally considered good. However, this can vary again by industry, so you always want to compare, but over 2 is considered risky. Now let's show how we calculate this. So we need total liabilities. In order to do that, we're going to go to the balance sheet and then scroll down to liabilities and shareholder equity. And then we want total liabilities. Remember, not current liabilities in this case, total liabilities, that's $19.07 billion. And then we divide that by total shareholders' equity, which we can find right here, $15.25 billion. And there you go. Also, one important thing to point out with financial statements, we're going off of the year of 2020, but as of right now, there's actually 2 quarters that have come out with this company, their quarterly earnings. So that means the calculations that we're doing are based on 2020 numbers, which may not be the most up-to-date numbers. If you want the most up-to-date numbers, you're gonna have to go to the quarterly numbers, and in some cases, you will have to multiply quarterly numbers by 4, or depending on how many quarters you have, or go back quarters and add numbers in order to create a whole year, if you're trying to get the most recent ratio possible. Now, many sites will offer these ratios as well. You don't have to always calculate them yourself, but it's important to understand it, and sometimes it is hard to find these ratios, so understanding it makes your life a whole lot easier when you're really trying to dig into a company. Now we have return on equity. This tells us how good the management is at returning a profit on the equity available to them. How much profit can they make on their existing equity? In order to calculate this, we take the net income and divide that by the average shareholders' equity. And with this one, you want to be in line or higher than competitors. This is a very important one that you compare to competitors, and it's a very useful metric. So let's show how you actually find the numbers here. In order to find net income, you go to the income statement, you scroll down, and you'll see net income. We see $2.06 billion. Now we need the average shareholders' equity. So this is if you're looking for a specific period, a return on equity, you'll want the beginning number and the end number, add them together, divide them by 2, get the average. But if you are just looking for a singular date, like the year of 2020, then you can just use shareholders' equity, which of course we know where that is at this point. We scroll down here, total shareholders' equity, $15.25 billion. Now, the last ratio that we're going to cover is the return on assets ratio. It's important to note this isn't all the ratios. There are so many, it's basically unlimited the number of ratios there are. These are just some of the top ratios. But now that you understand how to find the basics here, you'll be able to calculate other ratios on your own. So the return on assets ratio tells us how well a company can generate profits from its assets. This one is extremely important in my opinion. So the return on assets ratio is calculated by taking the net income divided by the total assets. Now, over 5% is generally considered good, but again, you're going to compare this to competitors. Also, it's important to note that some industries naturally make more money with fewer assets and are worth more because of it. Now let's find how we can calculate this. We're going to go to the income statement, find net income. We know where that is already. Net income right here, 2.06 billion. And then we need to go to the balance sheet and find total assets. So it's net income divided by total assets. So we're just going to scroll down about midway here. And we see total assets, $34.46 billion. And there you go, your return on assets ratio. Now, I said the return on assets ratio is extremely important, and that's because some industries naturally make more money with fewer assets and are worth more because of it. A business that earns more money on fewer assets is going to be valued higher because it's easier to earn an extra dollar in profits. So I made this example to help highlight why this is true. So we're really breaking down this ratio. So we have two companies. We have Timothy's Trucking Company and we have Pamothy's Programming Company. So Timothy's Trucking Company has $100,000 in assets and $20,000 in net income, with a return on assets ratio of 0.02. Pamothy's Programming Company, she has very few assets. All she needs is a computer, a keyboard, general stuff, and she can do her programming. So she only has $10,000 in assets, but makes that same $20,000 in net income. That means her return on assets ratio is 10 times higher than Timothy's Trucking. Now, what does this mean? You can kind of picture this if we reverse the ratio, if we turn it into an asset to income ratio. If we look at it in terms of asset to income, $100,000 divided by 20,000 is 5. In this case, it's 0.5, 10,000 divided by 20,000. So what that means, in order to earn an additional dollar in profit, on average, there's some economies of scale, but in order to earn an additional dollar in profit with Timothy's Trucking Company, he has to spend $5. He has to spend $5 on assets in order to earn $1 in net income. With Pamothy's Programming, she only has to spend 50 cents on new assets in order to earn an additional $1 in net income. Now, of course, like I said, there's different economies of scale and that it doesn't always go in a linear fashion, but you get the picture. Naturally, the more profit you can earn on fewer assets, the more valuable the company is because it takes less money in order to earn more money. Well, I somehow managed to chip my tooth in that last section. My front tooth. I don't know how I managed to do that, but either way, the show must go on. So now we need to narrow down our choices. We understand what stocks are. We understand financial ratios. We understand financial statements. We understand what risk is. So we need to take all of this and put it into a real world example, narrow down our choices, and understand which company we may want to think about investing in. So we're going to do this kind of Warren Buffett style, how he would take a look at a company, whether it's valuable or not, and then do a competitive analysis to see, does this company have a competitive moat around it? Is it hard for other companies to beat this in the long run? Because Warren Buffett would want to buy for a relatively cheap price, buy a great company, hold on to it forever through the grave. So we're going to narrow down our choices. In order to do that, the easiest way is by using a stock screener. So here in the computer, we are up on FinViz on their stock screener. I really like this stock screener specifically. And I put in some criteria to narrow down our choices because this starts with every single public company and you want to narrow it down to just the few that you really want to look at because we're going to spend a lot of time digging into the financials and what this company is all about. So you want to make sure that you're starting with a company that has good chances of you wanting to invest in it. So just covering the criteria quick that I'm looking at here. I did the market cap over $300 million, which is pretty small. Dividend yield over 2%. We know what dividends are. I did the country USA. Now you may want to do foreign countries. You may want to do a completely different search. This is just a Warren Buffett style search. And if we go up to the fundamental tab, this is where we use the ratios. So we're looking for a PDE of under 15, a current ratio of over 1.5, a price to book of under 2, and that's it. Just those few criteria, that narrowed down every single stock in the entire stock market to 14 options. 14 options. From here, we can take a look at these 14 options, choose maybe 5 or so, and really dig into those 5. Now, we can see Tyson Foods, that company that we were talking about earlier, is on here. So of these 14 companies, the one that jumped out to me as most interesting was Viacom. So I went ahead and put all of the data from Viacom onto this spreadsheet. I pulled all the data, put it on this spreadsheet. Also, if you like this spreadsheet, after we do this little analysis, the download link will be down in the description. It's completely free. All I ask for is a like, a subscribe, maybe a share on this video. You know, it's up to you. So the first part here is just the basic stock screener criteria. We're familiar with all of these ratios. We're familiar with everything here. And we know that Viacom hits these criteria because they were as a part of the screener. So we know that. And then we have the competitive advantage aspect. Warren Buffett looks for a competitive advantage. Is there a moat built around this company that is hard to beat by competitors? So there's a lot of different ratios that we can use in order to help determine, hey, does this thing have some sort of competitive advantage? The first one is gross margin. I have notes here all on the sides as to what each of these is. So gross margin used to analyze a company's efficiency in producing and distributing its product. And how this is calculated. So we have a gross margin here of 39%. SGA to profit, that's selling, general, and administrative to profit. With this ratio, you want to take a look at the financial statement and make sure that it is relatively stable over time. If the selling, general, and administrative is staying the same but profits are increasing, that is a great sign. Research and development to profit, in this case, they didn't have a whole lot of R&D. Depreciation to profit, we have a ratio of 40%. You want to do a competitive analysis for this. You'll want to pull their closest competitors and see, hey, how do they fare? Receivables to sales ratio, 27%. Again, you want to compare that to competitors. Return on assets ratio, we're at 4.39%. We really want that up over about 5%. But with this, it doesn't have to hit every single one. It's more like a grading scale where the more the better, but if it misses one or two, that can potentially be okay as long as it makes up for it in a different area. Return on equity ratio, we want this between 15 and 20%. We're sitting at 15.03. That is great. And again, you want to compare all of those to their closest competitors. That way you really see where they stand. Because if you have a company that is in a healthier financial position than its competitors and it's selling for a relatively cheap price, that is a company you may want to buy. And then we have a few other things here. Interest expense, how much are they paying on their debt? You can find this on the income statement. What is their net income compared to revenue? 9.1%. Again, you want to compare that to competitors. What are the earnings per share? So earnings per share, you really want to see that stable stair step over time. I wrote chaotic here because with Viacom, they're kind of all over the place, but they are trending upwards. Cash on hand, 2.98 billion. Cash on hand can mean a couple things. It either means the firm has a competitive advantage, which you want to see, or the company sold off a business or a ton of bonds, which could potentially be bad. Inventory, with this company, they don't have a ton of inventory, but if you see the inventory increase and net earnings increase at the same time, that is a great sign. Goodwill, typically, if you see a big jump in goodwill on the financial statements, that means that there was some kind of acquisition, so that's something to consider. Additional stock, if you see treasury stock, that's a good thing. That means the company is buying back their own shares, which effectively means your shares are worth more money. Preferred stock generally isn't great to see. Generally, great companies don't have preferred stock. And then investments and debt. I like to see a company who can pay off all of their debt with net earnings in 3 to 4 years. So in this case, it's 9.22. So it's not the greatest, but sometimes other ratios can make up for pitfalls like I mentioned earlier. But then this isn't the full picture. You want to take this, you want to compare it to competitors, you want to compare it to industry averages, and you also want to compare that industry to other potential industries that you can invest in because you want to put your dollar in the area that has the greatest odds of future success. So there's a few other things that we want to take a look at when analyzing a company. First off, who is the management? If you go onto this company's website, on any public company's website, you'll be able to find leadership. I like to look at the leadership and see what they've done in the past, especially if there's new leadership. I really like to see who they are, what they're all about, because they're the ones who are leading the ship. I also like to take a look at competitors, like I've mentioned, industry analysis. You can a lot of times type in the industry and see what the growth trends are and the projected growth trends. If the projection is very high, then it may be an industry that you want to invest your dollars into. News catalysts. I really like, before I buy a company, to check out basically all the news articles I can find within the last like 6 or so months, just to see what's going on, what's up with the company, is there drama, what's the general consensus. And then earnings calls. This is huge. Every quarter, public companies do an earnings call where analysts can come in and ask the executives questions. I can't stress how great it is to listen to these calls, because you can actually get a sense of the executives, where they're at, and kind of almost who they are as people. And it gives you a lot more context around the numbers that we're looking at. It is extremely helpful. So I strongly recommend taking a listen to a couple earnings calls before you dive deep into a stock. And if you do all these things, is checking all your boxes, then maybe you want to make a solid investment in whatever company that you're narrowing down if you're aiming for a value investment. Now that we understand fundamental analysis when analyzing stocks, we need to talk about technical analysis. This is the type of stock analysis that someone like a day trader would use in order to find which stocks to buy and sell on any given day. Now, a technical analyst attempts to evaluate what will happen next in a stock's price by studying its past. They believe that the past price action can be very telling as to what could happen in the future, both in buying and in selling, betting that it could go up or could go down. Now let's talk common items taken into consideration when using technical analysis to determine what's going to happen next with a stock's price. The first one is price trends. Is the price of a stock trending upwards? Is it trending downwards? Is it trending sideways or flat? And will that continue into the future? The next is chart patterns. Many technical analysts believe that price action moving in specific ways can tell us what will happen very likely in the future. Then we have moving averages. What is the average price over a given span of time? That could be 30 days, that could be 200 days. What is the average stock price compared to the current stock price? Then we have support and resistance levels. A lot of times when you're looking at a stock, you'll see the price bouncing up and down on the charts. Let's say it's at $22 right now, and you've noticed at $20, every time the stock goes down to $20, it tends to bounce back up. That would be called a support level. Now, if it was at $22 and you've noticed that every time it hits $24, it bounced back down, that would be called a resistance level. And then finally, we have volume of shares traded. An increase of the volume of shares traded could mean that the volatility of that stock, the likelihood of it going up or down, increases as well, which means that stock could dramatically trend upwards or downwards as a result of that increased volume. So now let's say you've done your due diligence, you've dug into the financials of a stock, and you're thinking, you know what, I want to buy some of this stock. I think that this stock's going to go up. But how do you actually make a purchase? So we're going to discuss this. Let's discuss the top two most common order types. We have market orders and we have limit orders. By far, market orders are the most popular. This is an order to buy or sell immediately at the current prevailing stock price. Now, it's important to note that the last posted price is not necessarily the price that you'll actually pay due to market volatility and the liquidity of the market. It could fluctuate. Now, this generally is not a big deal, especially for smaller orders. You're likely going to pay within a couple cents of whatever the price says currently. With extremely large orders, then you can have prices executing at various price ranges or price points, and your order might not be exactly what it says on your brokerage. And then we have limit orders. A limit order is a buy or a sell order that will execute if the price reaches a specific number. So let's say the price of a stock that you're looking at is $20, and you want to sell some if the price happens to hit $25. You could set a limit sell order at $25, and then once the price hits $25, your shares will automatically be sold at that price point. Now, it's important to note that a limit order is not guaranteed to be executed, because if it never hits $25, then it simply will not execute. So in order to explain this further, let's go over to a brokerage, and I will do this step by step so you can see me actually making an order. And this is a brokerage called Webull. If you don't have a brokerage yet, if you're looking for one, or if you want some free stocks, they are linked down below. They actually have a promotion going on as of the recording of this video that gives you 2 completely free stocks valued between $30 and up to $2,000. It's more likely to be around $30, but hey, it's still $30 free. All you have to do is deposit $100 into your account, and they send you 2 free stocks, plus they send me a free stock as a thank you for sending you their way. So let's do a couple orders here. We have Palantir up. So in order to find a company, you want to type in the ticker symbol here. we have Palantir, and we're going to buy 10 shares as a market order. So we're fine with the prevailing price right now. We're fine to the price of $25.37. The time in force, we're just going to leave that on day. And then you just click place order. It's really that simple. If you wanted to sell, you would just have it on sell. It would sell at the prevailing rate. If you happen to hold shares, you just click place order. Now let's do a limit order. Okay, we want to buy 10 shares again, but we're going to do it this time at a limit price, let's say, of $24. If the price goes down to $24, we want to buy 10 shares. That's effectively what it's saying. Now, time in force, we have some options here, either day or we can do good till canceled. With day, if the order is not executed by the end of the day, it will be automatically canceled. With good till canceled, it only cancels once you manually cancel it. So we're just going to leave it on day, and then you just click place order, and this would execute if the price dropped down to $24. Conversely, if we wanted to sell, let's say at $27, if we wanted to sell our shares, we'd just type in 27, we'd leave it on day, place order. If the price happened to go up to $27, it would automatically execute that sell order. So it's not too confusing. It's pretty easy, especially with this brokerage. They make it pretty darn easy. Most online brokerages are fairly easy to buy and sell your stocks. Now let's talk about everyone's least favorite subject, taxes. Because you put in your due diligence, you understand the stock market now, you valued a stock and you found a bargain, you bought that stock, and now you're ready to sell, you sold for a profit, and you still need to pay taxes on that profit. So we're going to talk about how taxes work when you sell a stock and how taxes work when you get paid a dividend on a stock. And then we're going to cover some strategies on ways that you can save some money on your taxes in your investments so you don't have to get crippled and crushed like this guy. I tried to make it my face on this little cartoon that I drew, but I ended up looking like a thumb. I went with this guy instead. So let's get into it. Capital gains taxes. This is the taxes that you pay when you sell your stocks. There's two kinds. There is short-term capital gains tax and there is long-term capital gain tax. So in the short-term bucket, this is tax on the profit from a sale of an asset that you held for less than 1 year. The taxes, if you hold less than 1 year, are higher than if you hold longer than 1 year. So if you buy a stock and 6 months later sell it for a profit, you're going to pay more in taxes than buying a stock and selling it a year and a half after your purchase. If you hold less than 1 year, you pay taxes at your normal income tax rate. And then long-term capital gains, the tax that you pay on the profit of the sale of an asset that you held longer than 1 year, is significantly less. In some scenarios, 0%, depending on your income. We're going to break down both of these even further. So short-term capital gains, under a year. This is a chart that breaks down the rate that you pay, the rate in taxes on your gains based on your income and your tax filing status. So if you're single and you make between $40,126 and $85,525, you're going to pay 22% on your gains. If you are married filing jointly and you made between $171,000 and $326,000, you're going to pay 24% on your gains. If you're married filed jointly and you earn under $19,750, then you're going to pay 10% on your gains. So you can see the taxes are fairly high when paying short-term capital gains. That's what makes it even harder to day trade and to do short-term trades, because not only are you not getting the compounding effect of your money making money for you, you have to pay taxes on every time you win, and it's hard enough to win as is. So then we have long-term capital gains. It's a little bit more simple with taxes on long-term capital gains. So we have the filing status again and the rate that you pay. So if you're single and you earn up to $40,000, your rate is actually 0% long-term capital gains. If you're single and you make between $400,000 and $441,000, a huge range there, you pay 15% long-term capital gains. So we compare that to the short-term, this is significantly less. If you're married filing jointly, you can make up to $80,000 and pay 0% long-term capital gains. Buying and holding is the best strategy tax-wise. It's the easiest to win tax-wise. And then we have dividend taxes. So there's two different kinds of dividends. There's qualified dividends and there's non-qualified dividends. Just about any company that you're investing in is going to be qualified dividends, with the exception of REITs. If you happen to be buying into a REIT, beyond a REIT, it it has to be a fairly complicated or fairly unique investment to fit the non-qualified dividends area, but we're going to cover it either way. So qualified dividends, the taxes on your qualified dividends are paid at your long-term capital gains rate. So those lower rates, you can go back to that chart if you want to compare what exactly that would be. Qualified dividends are dividends paid by a U.S. company, a company in U.S. possession, a foreign company residing in a country that is eligible for benefits under a U.S. tax treaty, or a foreign company that has a stock that could be easily traded on a major U.S. stock market. So you can see most companies that you would invest in fit within the qualified dividend criteria. And then we have non-qualified dividends. With non-qualified dividends, you pay your taxes at your short-term capital gains tax rate. So whatever your normal income tax rate is, that's what you pay on your qualified dividends. Some examples here are REITs, real estate investment trusts, a MLP, which is a master limited partnership, and dividends on employee stock options. And those are just a few of the more popular examples of non-qualified dividends. But again, most of them are qualified dividends. Now from here, let's talk about how you can legally avoid a little bit of that tax burden by using a retirement account. We're going to break down the two most popular retirement account types. The first one is the classic 401k. This is an employer-sponsored retirement plan that allows you to invest a portion of your income pre-tax. So let's say you had $1,000 that you wanted to invest. You would not have to pay your 20% or so in taxes first before putting this into a 401k account. And that's why people like these accounts, because you get to invest a dollar amount that is higher because you haven't yet paid taxes on it, but then you do pay taxes when the funds are dispersed after retirement. We'll talk about that in a second. So your investment options with the 401k are a little bit limited, and this varies pretty wildly depending on your provider, but many times you're limited to either mutual funds or ETFs. Your contribution limits are higher on this one than the other option. The limits here are $19,500 if you're under age 50. If you're age 50 and older, the limit is $26,000 a year as kind of a catch-up to allow you to build up that account a little bit higher. And one huge benefit with the 401k is your employer can actually match a percentage of your wages as a contribution, especially if you work for a large company. Many of them have some kind of employer match, and it is an awesome way to get some more retirement money. If your company offers that, it's generally a good idea to do so because of the tax benefits, and hey, they're throwing in extra money for you. Why not do it? Now, it's important that you will pay taxes after you retire and start receiving this money. The thing is, though, that the taxes are paid at your income tax rate when you're retired, sometime after you're 59 and a half years old. So many people will opt for the 401k because they feel their tax rate is going to be higher when they're working than when they're retired, which makes sense because you're working and making that income. So hopefully you're paying taxes on a lower tax rate. Now, it isn't a one or the other kind of scenario. You can have multiple types of retirement accounts, especially if you're really balling and you can just max out all sorts of retirement accounts. And that brings me to the next option, the Roth IRA. So this is a retirement plan that is set up directly between you and a stock brokerage. And basically all stock brokerages offer some kind of Roth IRA account. So whatever your favorite brokerage is, there's some link down in the description. You can use them and they have a Roth IRA. It's very common. With the Roth IRA, you have more freedom in your investment choices. You can really invest in anything, any securities you choose. Oh, and something important to mention, just putting money into your retirement account, both for the Roth and the 401k, does not necessarily mean that it's invested. It could just be cash sitting there. So you want to make sure that it's actually invested into something. I've heard of this multiple times. People thought that they are investing in their retirement account and they're just simply sitting there in cash because they didn't think like, oh, I have to actually put this in something like an ETF or an index fund. So that's something important to note. The contribution limits for this are significantly lower, $6,000 per year if you're under age 50, $7,000 per year if you're age 50 or older. So in order to make a full contribution, if you're a single filer, you have to make under $125,000 per year, and then that contribution phases out between $125,000 a year and $145,000 a year. And then if you're married filing jointly, you can make up to $198,000 a year to get that full $6,000, and then that phases out to $208,000 per year. And at that point, you can no longer use your Roth IRA account. Now, The difference with taxes here is you pay taxes on your income before it gets placed in the Roth IRA account. So you make that $1,000, you pay your 20% in taxes or whatever your rate might be. You get to invest the $800, and then that compounds, but you don't pay taxes when you receive the disbursement. So no taxes on the back end. So it accrues, you get to pull it out tax-free. Now, it's important to note that it's only tax-free withdrawals if you're withdrawing after age 59 and a half. There are some penalties that can be accrued if you withdraw before that age. Now, I know that it's kind of confusing, the differences between the Roth IRA and the 401k. So here is a chart that breaks down all of the various differences. We talked about a lot of these. Some of them we didn't talk about, so feel free to pause this if you're really trying to decide which one is best for you, and then you can see all the various differences here. But you can do both, and if you choose one, it's not the end of the world. It's not like, it's not like you're gonna go bankrupt if you choose one or the other. So feel free to pause that, take a screenshot, whatever you need to do to make a comparison here. And wow, that is it. That is the presentation. I can't believe I'm finishing this up because got stuff falling over there, because this took me so long to put together. You don't even know how many hours this has taken me. You can see my eyes are literally bloodshot doing this. So the question is, what now? And I have some suggestions for you. First off, take the quiz. I made a quiz to accompany this entire presentation. Take that, see what you understand, see what you don't understand, and then maybe watch some sections again that you didn't quite understand on the quiz. And then share the results with me. Tag me on Instagram at Maxwell_Maher. Tag me, and I will help celebrate your victory if you got a good score on the quiz. Also, continue your education. We're not done yet. I'm not done yet. You're not done yet. Keep reading, keep learning, watch more content, subscribe to this channel because I post tons of stuff like this. Subscribe to other financial channels. Keep on learning. Watch this content again. A suggestion that I have is copy the link to this presentation, put it in your calendar, set a notification for a week from now, and watch it again and see how much you actually remember. Chances are you're probably only going to remember like half of it. And you'll watch it again and you'll maybe understand 75%. And you watch it a third time, you'll probably understand 95% of it. Share this also with someone who you think could use some more financial knowledge or think that they would enjoy this, a spouse, a cousin, your weird uncle, whoever you think could benefit from this. Another option is join our Patreon. We have a huge group of people who are dedicated to learning and investing, and it is extremely helpful to have this community of other people. That way you're not making any rash decisions. I'm on there. I post my buy alerts whenever I do my due diligence and then buy a stock. We have private live streams, there's private content. There's a lot going on there on the Patreon. You'll get this entire presentation. You'll be able to download it if you want. All you have to do is join that Patreon. That's linked down below. Also, show off your knowledge. I think one of the best ways to really reinforce learning something is to explain the concept that you learned to someone else, because it forces your brain to really understand what's going on, and it makes you recognize what you don't actually know, and then you can go back and learn those concepts again. And then finally, grab your free stocks. If you don't have a brokerage yet, if you already have one, there's some free stocks in the links down below. There's some current offers for Webull, Robinhood, and M1 Finance. Webull tends to give the largest amount in bonus by making an account, and then Robinhood and M1 Finance are pretty good as well, but you get free stocks with all of those. So do all those things and you should be pretty set when it comes to the beginnings of becoming an investor. And congratulations for making it through this. And thank you for watching. I enjoyed making this. I hope you found it useful. And of course, I hope you have a profitable day.